This recession indicator hasn't been wrong in 58 years. Now, when the curtain closed in 2023, Wall Street and every investor had plenty of reasons to cheer. The 127-year-old Dow Jones Industrial Average climbed to a record high last year, while the benchmark S&P 500 and growth stock-powered Nasdaq Composite catapulted by 24% and 43%, respectively. But a new year brings new questions for investors. Topping the list, where will stocks head next? Although there is no such thing as a forecasting tool that can, with 100% accuracy, predict directional moves in the Dow Jones, S&P 500 and Nasdaq Composite, there are a couple of predictive indicators that have strongly correlated with movement in the three major stocks indexes throughout history. One such indicator, which hasn't been wrong for the past 58 years, has a potentially ominous warning for investors. This recession forecasting tool hasn't been wrong since 1966. While there is no shortage of metrics investors are using to try to gain an edge on what might happen next with the stock market, is the Federal Reserve Bank of New York's recession probability tool that appears to offer the biggest clue. The New York Fed takes into account the spread, that is difference in yield between the 10-year Treasury bond and the 3-month Treasury bill, to determine how likely it is that a U.S. recession will take shape within the next 12 months. Normally, the Treasury yield curve slopes up and to the right. In other words, bonds that mature a long time from now will support higher yields than bills set to mature in mere months. The longer your money is tied up in a security, the higher the yields should be. Trouble arises when the Treasury yield curve inverts. A yield curve inversion where short-term T-bills have higher yields than a longer-dated T-bond signals concerns about the U.S. economic outlook. Although not every yield curve inversion is followed by a recession, every recession following World War II has been preceded by a yield curve inversion. Think of it as a necessary ingredient to potentially a downturn in the U.S. economy. Every month, the New York Fed updates its recession forecasting model. The steeper the version of the Treasury yield curve in more than 4 decades has pegged the probability of a recession taking shape by or before December 2024 at 62.94%. To be fair, the Treasury spread has incorrectly forecasted a recession once before. In October 1966, the probability of a U.S. downturn briefly surpassed 40%, but no recession ever materialized. But since 1966, the New York Fed's forecasting tool has been as trustworthy as the sun rising in the east. If the probability of the U.S. recession has surpassed 32% since 1966, a recession has without fail always followed. Now, considering that the currently probability of an economic contraction is nearly 63%, the writing appears to be on the wall that a recession is in the card for 2024. Even though the U.S. economy and stock market aren't linked at the hip, corporate earnings usually decline during a recession. Furthermore, approximately 2/3 of the S&P 500's drawdown since the Great Depression have occurred after, not prior to a recession officially being declared. In simple terms, stock would be expected to perform poorly if a recession arose this year. But wait, there's more. Interestingly enough, the New York Fed's recession indicator isn't the only worsening correlation attached to the nation's central bank. The Federal Reserve's monetary policy can also offer big clues as to what's next for stocks. The Fed's monetary policy describes the action it takes to maximize employment and keep the prevailing rate of inflation at modest levels over the long run. Though the nation's central bank has a handful of tools at its disposal, the most common means to effect change is through the federal fund rate. A declining interest rate environment is usually viewed favorably by investors since it encourages lending, which can then be used by businesses to hire, acquire, and innovate. Conversely, a rising rate environment can be seen as putting the brakes on a growing economy. However, the comparison isn't quite as cut and dried as it seems. The nation's central bank doesn't reduce interest rate on a whim. Historically, it lowers the federal fund rate when clear signs of trouble have emerged. As much as lower interest rates might seem attractive to investors, they've typically been a harbinger of poor performance to come for Wall Street. Since this century began, the Fed has kicked off 3 rate easing cycles, which began in January 2001, September 2007, and July 2019. Following this initial rate cut, it took the S&P 500 645 calendar days, 538 calendar days, and 236 calendar days, respectively, to find its bottom. In 2024, the Fed is forecasting 3 rate cuts, although not every rate easing cycle throughout history has been bad news for Wall Street. Recent history suggests trouble lies ahead. Patient investors are still sitting pretty. Now, based on the latest round of data from the New York Fed's recession indicator, along with the performance of the major stock indexes following the start of a rate easing cycle since 2000, there seems to be a lot for investors to smile about. However, perspective changes everything on Wall Street. Since World War II ended in September 1945, the U.S. economy has navigated its way through a dozen recessions. Just 3 of this 12 downturn reached 12 months in length, while none of the remaining 3 saw past 18 months. By comparison, 2 periods of expansions over the past 7 to 8 years have lasted at least a full decade. The key point is that economic expansions handily outpace recession over long periods. Now, this disproportionate optimism is also seen when examining the length of bull and bear market for stocks. Last June, the researchers at Bespoke Investment Group released a dataset comparing the average length of bull and bear market in the S&P 500 dating back to the start of the Great Depression, that's September 1929. Whereas the average bear market stuck around for a modest 286 calendar days, that's about 9.5 months. The typical bull market lasted 1,011 days, or approximately 3.5 times as long. Furthermore, even though there have been 39 double-digit percentage declines in the S&P 500 since the start of 1950, every notable drop, save for the 2022 bear market, has been decisively wiped away by a bull market rally. We're never going to know ahead of time precisely when downturns will begin, how long they will last, or how steep the decline will be. But history is crystal clear that bull market eventually pushed the Dow Jones and S&P 500 and also Nasdaq Composite to new highs. This effectively means that every pullback in the major stock indexes represents a surefire buying opportunity for patient investors. Regardless of what 2024 holds in store for the U.S. economy and the stock market, patient investors will be sitting pretty.